Good afternoon, everyone. I am Jessica Bird, Associate Editor of Mortgage Introducer, and I would like to welcome you all to our live webinar in association with JBA Risk Management, otherwise known as the Flood People. So now that the vaccine scheme is well underway and lockdown measures are easing, hopefully for the last time, it's possible to look past the pandemic and start to consider other global challenges that are rising in importance, the most pressing of which I think we can all agree being climate change. Beyond incentivising the creation of more eco-friendly properties, lenders must also work to understand the physical impact that's already on the cards, as well as those physical impacts that are most likely to be felt down the line in the future. Most notably, the growing flood risk that's facing large swathes of properties across the UK. So, what are the impacts of flooding? What does this mean in terms of risk and stress tests? And how can lenders go about assessing the viability of properties in the long term with these considerations? This is where JBA comes in. Vanessa Bamborough, Property and Finance Sector Specialist, is going to talk us through the business approach to providing comprehensive, detailed data and the value that this then has in making those all-important long-term risk assessments. We'll then have a question and answer session with Vanessa and Modelling Manager Judith Ellison after the presentation. Many of you have already sent in your questions, but please do use the Q&A function on your screens if any more come up as you listen. We'll do our best to get through as many as possible in the time that we have. And for any that we don't manage to answer, the JBA team is going to respond offline. So all that remains for me now is to hand over to Vanessa to kick things off.
Hi, thank you for the introduction, Jess. Hopefully you can see my screen okay. It's great to join you today to speak about climate change, flood risk and JBA's data. I'm going to start with a short presentation that covers data available to help with regulatory stress tests and the CBES, as well as assessing climate risk more generally. So assessing and managing flood risk now and in the future is key for banks, lenders and others in the financial sector. In the UK especially, flood is one of the most widespread hazards affecting properties, assets and other investments in terms of damage and financial costs. It's difficult to assess flood risk without comprehensive data, which is where JBA comes in. We have flood maps and associated flood data available globally, including our UK flood maps, which are a 5-metre resolution. We have river, surface water and coastal available, and we also consider flood defences. More and more banks and property managers are contacting JBA to access our flood data to help with their businesses. Lenders in particular are concerned with mortgage origination, assessing their back books against the increased risk of default on loans due to the financial pressures individuals face after being flooded, and regulatory stress testing, of course. This interest extends beyond current day flood risk. When a mortgage term could be over 30 years or more, it's important to understand how that risk might change, or whether a property that isn't at risk now might be at risk in the next 10 years. So we've used our leading flood maps to develop a new range of analytics for a future climate, and I'm going to demonstrate how we use our flood maps to estimate future flood scenarios and how lenders can consider using these, not just for the upcoming stress tests, but also as a tool within their everyday business. So climate change isn't simple, and there are many aspects to consider, but we don't have time to get into all that today. So what I do want to inform you about is the importance that to understand that we've used UK climate change projections 2018, which we'll refer to as the UK CP18. This climate model gives us climate scenarios represented as a representative concentration pathways, which are referred to as RCPs. We take this climate science and we apply it to data to create a potential future flood depth for each RCP and time horizon, and we call this collection of data the Climate Change Data Array. The data underpins our recently released Climate Change Analytics, which is a series of data sets providing future views of flood hazard and risk in a variety of data formats. The data suite is the largest and most comprehensive range available for the international financial sector in understanding potential future flood risk. It includes the full range of RCPs and every 5-year time period between 2025 until the end of the century. And we have this available for all our flood types. So as you can appreciate, that is a lot of data available to you. With this information, we can generate new data sets, such as our climate change index. And we can also use the underlying data array as input to generate climate change versions of our existing static data sets, such as our flood scores and our pricing data. These are then directly comparable to their baseline counterparts. I'm going to explain a little bit more about each of these products in the coming slides. So first up is our climate change index. The data provides an easy to use and easy to understand view of changing flood depths by converting the absolute change in flood depth from the climate change data array into a relative percentage change. As with most of our other analytics data, the index is available at property and postcode level. And although the data is delivered as a CSV file, it is possible to visualize it in a GIS, a Geographical Information System, as we've done in the graphic on the left here. The image on the left shows an example of postcode level climate change index data under RCP 4.5 for the period of 2036 to 2040, whereas the image on the right represents our flood depths, showing out the current flood risk. As you can see by the orange dot on the image, a property in this area could face up to a 300% relative increase in flood depths in the future. But this change may be as little as 0.1 metres to 0.4 metres of flooding in that scenario. When used alongside our flood maps, the Climate Change Index provides an easy way to identify which properties and assets may experience more or less severe flooding based on changes in flood depths. And this information can be used for improved decision making. For example, understanding potential devaluation, risk of default after a flood event, impairment charge assessments, or to decide which properties might require a more in-depth assessment before investment to prevent future hotspots of risk. Secondly, let's talk about our climate change flood scores. Our flood scores are based on JBA's flood matrix, which is used to identify flood scores relevant to a given property based on the severity, frequency, and type of flood. So the highest scores denote properties that are likely to suffer from frequent and extensive flooding. The climate change scores enable you to see how the flooding could change over the term of the mortgage or investment period, and can also identify those properties that may be susceptible to devaluation. For example, a property that scores a 12 now may increase to a score of 24 in a future scenario, and you could request further detailed reporting on that property before you decide whether to invest. Scores also provide a consistent message throughout the home buying process, as they are used by insurers, property search, valuation surveyors, as well as lenders. In addition to the flood scores, we also have a climate change floodability dataset. This is derived from grouping the flood scores into traffic light colour bands. And this is an ideal screening tool for property assessment, for which you can base your decisions on. For example, using the different colour bands for different stages where more detailed reporting is required. JBA's floodability data has been used by property search and valuation surveyors for many years now, and lately has been adopted by several lenders for mortgage origination purposes. And finally, we also offer future financial metrics, such as our climate change pricing data. Pricing data is used as a pricing tool for insurers to determine how much premium to add onto an insurance policy for flood. But this is also being adopted by lenders as input into their credit risk models ahead of the upcoming stress tests. The pricing data also helps when considering loss associated with property devaluation due to flood, as well as estimating loss with mortgage default, and can aid impairment assessment calculations. So pricing data represents the average annual loss to location, which was represented as an average damage ratio, which I'll refer to as an ADR. Through the climate adjusted depth information, the data array offers, we're able to calculate climate change versions of our baseline pricing data for future risk. Let's look at an example of a residential property. The property highlighted on the graphic has a rebuild cost of £175,000, but when multiplied by the ADR value gives an annual damage cost for that property of £43.75 within the present day climate. But under a future scenario, with the increase in flood depth, we can recalculate the ADR and the potential future annual cost of flooding to this property, which is now estimated as £87.50. Future decisions or further assessment can then be made on this to reduce future losses. So, as you can see, the climate change analytics provide a suite of useful and usable data to help you make effective long-term decisions. And the understanding of the longer-term impact of flood risk in future scenarios on the property in which you and your clients invest through all stages of the mortgage process. And of course, on top of everyone's mind at the moment is the UK regulatory stress tests set to be released in June 2021. JBA's data will help assess the physical component of these tests. Well, that's all the slides done now, and I hope you found that useful. I'll now pass you back to Jess, as I think we have some questions already.
Fantastic. Thank you so much, Vanessa. I think we can all agree there's a lot of interesting information there, and some real signs that we all need to be thinking long term and realizing the benefits of data analytics to help us understand the big picture. We've got quite a lot of questions to get through, so just before we get started, I'd like to thank everyone who submitted, either in the run-up to today's event or during the presentation. I know a couple came in. We'll try and get through as much of this as we can now, and obviously, as I mentioned, Judith and Vanessa will also be getting back to anybody that we don't manage to get around to. So, Vanessa, I'd like to come to you with our first question. You've made it very clear that climate change is likely to increase flood risks in the future, but what does this mean in real terms?
Well, there is evidence that climate change is already impacting flood risk and therefore property risk. And JBA was part of a research group that investigated this, and it found that greenhouse gas emissions are likely to have increased the chance of flooding in winter 2013-14 in many parts of Great Britain. So that supports the idea that climate change is happening and is having an influence today. Our data also supports this, and our data suggests that an extra 1 million people could be at risk by under a 200-year flood event by 2040 in Great Britain alone, under a realistic warming scenario. And under the highest emission scenario, an extra 1.3 million more properties could be at risk at the 200-year return period by 2100. But similarly, annual average losses could be increased by up to 30% for UK residential properties under a realistic warming scenario. Our climate change work also suggests that we will have more frequent intense rainfall events, which will vary regionally, causing a rise in surface water flooding in particular. And, you know, as an example of the regional variation, in the northeast, for example, we may expect it to become wetter due to having more frequent and intense rainfall events, whereas in the southwest, it could actually become drier due to having less rainfall and less frequent intense events. So it is clear that there's a huge potential for impact on flooding from climate change in terms of severity and also the frequency, where flood is estimated to get worse in the future. So this is a real concern for property investors like mortgage lenders.
Yeah, certainly it's been thundering down with rain all day here, so it feels very real at the moment. Thank you for that explanation. Jude, if I could come to you for this next one. As a result of the changing climate and the effects that Vanessa's outlined in terms of risk, as mentioned, the Bank of England has adopted more regulatory requirements. Can you give us some background on the CBES and its timing?
Sure. Well, as Vanessa's already mentioned, climate change, there's plenty of evidence that it's already happening and that it will have a financial impact. And as such, there's been a strong move for regulatory assessment. So the CBES is the Climate Biennial Exploratory Scenario that's being run this year. And the Bank of England PRA have asked the UK largest banks and building societies, life insurers and general insurers, as well as 10 Lloyd's managing agents to perform this test. Now the purpose is to look at the financial risks posed by climate change. In terms of timelines, the official launch and final guidelines will be released on the 8th of June. The submission by participants will be in mid-October. It's possible then that there'll be a second round in January 2022, and the Bank of England will publish their results in Q1 22.
So from a firm's perspective, what's going to be involved? What's expected of them, especially in relation to flood risk?
Yeah, it's a good question. So flood falls under the category of physical risk. Now there's 3 types of risk that can be considered. So physical risk refers to property damage by more frequent or severe events such as flood and drought. Then there's transition risk. So as we move to a greener economy, there'll be a shift in asset values and costs in doing business. And transition risk impacts in particular high fossil fuel industries. Then finally, there's a liability risk. So this is where people or business seek compensation for losses from the physical or the transition risks. Now, the Bank of England has asked firms to look at 3 exploratory scenarios and multiple time horizons. There's an early, late, and no policy action scenario. So best, average, and worst in terms of societal action to combat climate change. Now, those scenarios are also closely aligned to the Network for Greening the Financial System, NGFS scenarios, orderly, disorderly, and hothouse world. Now, as Vanessa mentioned, for flood, the things we need to look at are the changes in precipitation and sea level rise. But the Bank of England have yet to confirm the variables that they'll recommend using for flood risk. But as there's a short time from release to submission, JBA, as Vanessa has mentioned also, has created the suitable data to make comparisons, and then we'll make comparisons with the bank variables when they're available. So the PRA say this is an exploratory learning exercise, and there's no requirement to test capital adequacy. It should be used to identify gaps and weaknesses, should forge greater board and senior management awareness, stimulate business discussions, identify business risks and opportunities, and ultimately lead to enhanced management of financial risk.
Thanks. I think, one of the things that becomes clear in that is the importance of engaging with these processes in order to then build better models for the future. Vanessa, we've got one for you here. You've mentioned scenarios quite a bit, including RCPs. For anybody who isn't familiar with the scientific terms, can you elaborate on some of these, please?
Of course. So an RCP is a representative concentration pathway, and they are time-dependent projections of atmospheric greenhouse gas emissions. And there's 4 pathways altogether: RCPs 2.6, 4.5, 6, and 8.5, where a 2.6 represents a low pathway, where an 8.5 represents a high pathway. And these pathways will examine how global society, demographics and economics might change over the next century. So that's saying how the changes we and our governments make today might increase or decrease the effects of climate change. And, there's three scenarios that can be applied, that are applied in the CBES, but they've not been formally linked yet to RCPs. But it is anticipated that the early and late policy action scenarios that Jude mentioned earlier do correspond most closely with RCP 2.6, whereas the no policy action she mentioned could be perceived as a 6 or an 8.5, depending on the actual climate change data used.
Thank you. So Jude, going back to the regulatory side, you mentioned that the Bank of England's work is exploratory and a learning exercise and a first step. Does this mean we're going to see an increase in regulatory initiatives such as this in the future?
Well, I think it's fair to say, yeah, and it's already happening. So CBES is not a one-off requirement. As I mentioned, there'll possibly be a second round, and then it will likely be biennial, ongoing. And also, while CBES is mandatory for some firms that I've mentioned, all PRA supervised firms fall under Supervisory Statement SS 319. And as such, they should have fully embedded their approach to climate change financial risk by the end of 2021. Now, a key driver behind all of this has been the Task Force for Climate-Related Financial Disclosures, or TCFD. And then they formed in 2015, issuing recommendations. Now, until now, the TCFD have been voluntary, but there's talk about this becoming mandatory in the UK as early as 2022. And outside of the UK, there's been requirements in France and elsewhere in Europe. The European Central Bank and EIOPA are looking at this. And then further afield in Asia, there have been moves in Singapore, Hong Kong, and Australia. And similarly, there have been requirements in South America, Canada, and under change of government in the US. But it's important to say that regulation is only part of the story, and it's not a tick box exercise. Firms, their boards and investors need to understand the risks and opportunities and build this into their risk management framework. And customers see the benefit too, in particular, the younger population. And market studies have confirmed this.
So essentially regulation will increase, but lenders shouldn't be waiting for that day to make what ultimately are the right choices and the right changes. So considering, with that in mind, considering the fact that addressing these issues takes both a long-term and a broad view, Vanessa, what else should lenders be concerned about from a business perspective? Are you seeing any common concerns from the people that you've spoken to?
Yeah, certainly. And the big concern here is that where a property or an area is frequently hit by flooding, then the property or area becomes less desirable by homeowners and therefore less insurable. And this can naturally devalue a property or the whole area and cause properties to fall into negative equity. Or the homeowner may default on the mortgage because they can't afford the flood damage repairs due to having insufficient insurance in place. Insurance is only really needed at the start of the mortgage application, and it's the homeowner's responsibility to inform the lender of any changes that occur during, throughout the term. But as climate change increases the frequency and severity of flooding to property, lenders are now concerned that properties that are insurable now may become uninsurable at some point through the life of the mortgage. And lenders also considering impairment charge assessments. We had a question submitted actually before the webinar that asked what a lender could do if it finds a property on its books which was insurable, which was okay now, suddenly becomes at risk to climate change, and exactly where that comes in. So a lender can use the data to understand where there might be a drastic reduction in the recoverable value of assets from any risks already on their back books. And they can calculate how much money they need to set aside to recover any additional costs in the investments due to climate change impacts. And then Going forward, balance this impairment charge capital with sustainable future investments. And also, just to add as well, as part of the mortgage origination, lenders are using JBA's data to screen properties to understand the flood risk of property now and through the term of the mortgage application. And this will help lenders make better business decisions. So, for example, more detailed reporting might be required on a property before deciding whether to invest. And the earlier firms can start to do this, the better. Some lenders, for example, who've been using JBA's data for several years, may now have naturally reduced the longer term impacts due to screening out those high risk properties over the years, and may face less impact in the future than others.
So it sounds like there's a big element of lender responsibility in all of this.
Yes, absolutely. Lenders have a responsibility to their customers, which is especially key for climate change. It's not just about lending or affordability. It's about protecting customers from any negative effects in the future caused by decisions made now. A lot can change over that 30-year mortgage term, and identifying potential issues now is just responsible lending.
Right. And Jude, you mentioned previously that the regulatory initiatives are now requiring assessment from both mortgage providers and insurers, where previously it was just insurers. Is that another element that lenders need to consider now and moving forward?
Yeah, it's a good question. So the link between insurance and mortgage lending is a big one, and Vanessa's already alluded to that. And firms are questioning how initial lending will be impacted by future insurance decisions. And a key area for flood is, and which stakeholders are actually currently looking into, is the impact of Flood Re ending in 2039. Now, Flood Re is a joint initiative between the government and insurers to provide cover for high-risk properties. And Flood Re themselves are also preparing for this transition. And one way was via recent consultation considering amendments to the scheme. So the kind of questions being asked by lenders are, will there be reduced insurance cover or higher costs of insurance for homeowners? Will there be an increase in adaptation such as property level protection or Build Back Better? And will there be new insurance strategies to cover the costs of these risks? And then also, will homes be built in flood-prone areas? If you consider the first of these questions, so will there be reduced insurance cover or higher insurance costs for homeowners? What might that mean for mortgage payments? And could it result in mortgage default? Well, the answer is we don't yet know, and firms need to understand the risks and start to prepare. And they can do this by looking at various options, so different loan to value ratios, different mortgage terms, completing detailed site assessments, and looking at site adaptations. And what I would say is JBA is a great place to start. We already have about 90% of the UK insurance market using our data, 6 of the top 10 banks and building societies, and a large number of home buying firms, so property search and conveyancing. And what this means is that consistent data is being used across the board.
So Vanessa, this brings us back to obviously much of the presentation. What's so special about the JBA data? What makes it really, really useful in this context?
Okay, well, having a complete set of RCPs derived from the latest science and having time horizons every 5 years up to 2100 means that we can actually support a multitude of needs when looking at the impact of climate change under short, medium and longer terms. And as previously mentioned, this is especially useful for lenders who are interested in understanding when insurability may change through the life of the mortgage, or determining at what stage a property may become a greater risk. The data is also very flexible, and there's lots of ways to integrate this as a business. And rather than creating static maps, we chose to attach flood and climate change data to property and postcode level. And where static maps are hard to maintain, our approach does mean that we can update annually, incorporating the latest flood map data and property information, and also provide a larger range of RCPs and time horizons than elsewhere on the market. Our data also offers a range of data sets depending on what you're looking to achieve. And if you're looking back at the presentation, I introduced the climate change index that allows you to do a more detailed assessment on flood depths for the property. Or you could be using the climate change scores or floodability to screen a property and provide that industry view of risk. And we've got the pricing data, which will help assess loss. And as a company, we've over 25 years experience creating flood data, and we've applied this experience into our products. And as Jude mentioned earlier, our data is well established and provides that consistent view of risk across the whole home buying sector.
So the data sounds very robust and there's a lot of, depth to it and everything. But if we're being realistic, how easy is it to work with? Not everybody has a team of scientists waiting to kind of analyze this data.
No, that's a really good point. And to be fair, it's really easy to use. As I mentioned earlier, the data is attached to property and postcode level. What this means is that the lender can simply take the data and attach it easily to their portfolio. And we provide ongoing support and training to the lender, helping them to understand the data to make sensible business decisions. And we can also offer bespoke consultancy where they need a little more help. But, we do understand our data is only contributing to the physical risk component, and lenders may need more information for the CBES or for the longer term planning. And also that some lenders may look for assistance to integrate the data into their systems. So JBA works with many partners, and it's these partners who can help lenders integrate the data and also provide extra data for using the CBES, for example, such as EPC data, subsidence, and other peril information. And these partners can also help visualize the flooding around a property, where's the flooding entering the property, for example, and offer a complete package. It does mean that lenders can just license with one company for everything they need rather than licensing with several companies. But JB also works with consultancy firms who create bespoke credit risk models for lenders. And these partners use JB's flood data and climate change analytics to help lenders with the CBES requirements, as well as the future impact assessments. We also had a question coming ahead of the webinar asking about energy performance assessments. And this is certainly an area where our partners can help. So there's two ways of using our data. You can either come direct for the physical risk data, or you can go via our partners, like some of the lenders that already license our data do. And like I said, going via partners will offer you both physical and transitional risks. But whichever way you choose to license JBA's data, we're there to support you and to provide you training, and we're more than happy to provide partner details on request.
Lovely, thank you. So staying on that subject of the robustness and quality of the data, we've got a question here that asks, clearly forecasts are exactly that, forecasts and not predictions. How can you provide certainty in your data? Jude, if I could come to you on this one.
It's a very good question. So I think it's fair to say we don't have a crystal ball. We don't know exactly what's going to happen. We do use the best available scientific data and methods, but it's fair to say that uncertainty remains. So I think I'd say that one of the key things is transparency, and we'll walk firms through the strengths and limitations, and we'll provide detailed technical documents and ongoing support. And we will adopt better data and methods when they become available. So I think I'd conclude that saying, despite uncertainty, it's important to start the journey and consider the future impact. And it's key for stakeholders to work together to learn and improve the risk assessment methods.
Great. Yeah, it sounds like it's something where the more the industry takes it seriously and gets involved, the better that we can kind of come to understand and plan for what's in the future, even if that does change. So speaking of actions that we can take now, our next question is about practical steps. So for those properties that we know are more of a flood risk but are otherwise a desirable prospect, whether it's location or type of building or whatever it is, would you suggest that the damage in those situations is done and people should look elsewhere for their investments? Or are there changes and fixes that lenders can perhaps incentivize to make these a more sustainable prospect in the long term? Vanessa, I'll come to you for this.
Okay, it's a very good question. And no, I wouldn't say the damage is done for most. There are still solutions in the form of property level protection. I'll refer to it as PLP. And PLP, it comes in two real forms: flood mitigation and flood resilience. So flood mitigation is actually having will stop water from entering the property, and they can come in the form of floodgates, for example, and they help for those who will become at risk in the future. Where flood resilience is actually a way of reducing the damage caused by floodwater once it enters the building. And that's there's different ways for flood resilience. It could be a matter of raising the electric sockets up on the walls, or it could be by, putting suitable flooring and kitchens in there that just wipe clean following floods. So there's some really good stuff out there. But lenders, may consider lending on a property that has property level protection, or it could be associated with, the lend on completion of the loan. But PLP does come with its concerns and its challenges, as it can fail. And just to give you a few examples, if a property owner doesn't have a regular maintenance program scheme in place, then it can deteriorate over time. And I hear quite often examples of how mice have eaten rubber seals, or the floodgates haven't been stored appropriately and they've gone rotten. Or it could be that, the homeowners have gone on holiday and forgot to put the PLP in place. And when's the flood going to hit? Yes, when we're on holiday, sunning ourselves, unfortunately. So there is a lot of challenges, and also you have to have the right PLP in place for the flood type that's going to affect that property. So there's no point putting a floodgate in place to protect against river and surface water flood, if the actual flooding that's going to affect that property is groundwater, because groundwater will come through the floorboards. So it's not simple, and it comes with a lot of challenges. But I think we don't want to give a false sense of security for lenders and homeowners by saying, yes, property level protection will work for everything, because there is a lot of considerations. But I think what we should be doing is looking at the bigger picture. So PLP is only one small part of the story, where really we need increased spending on national and local flood defence schemes and alleviation schemes, which do play a key part. And this is something that lenders and insurance could encourage the government to look at, perhaps. Last week, for example, the Environment Agency announced that the government had set aside £5.2 billion to invest in flood defence between now and 2027. And that should protect an additional 336,000 properties. But similarly, building regulations can also play a big part in mitigating flood risk by adding flood resilient materials during development, such as water pumps and water resistant materials, for example, if they were building in a flood zone, but also encouraging the high standard of development going forward. So there are solutions out there for lenders, and I wouldn't say the damage is done, but these solutions have challenges in themselves.
Of course, yeah, it's a multi-pronged and complex subject, essentially. And as you say, even when PLP methods do create increased flood resilience, lenders still need to be very careful about their long-term risk appetite. I think this question kind of follows on from that. So, because, for example, recent eMove data we've seen showed that some of the highest risk properties are also in some of the highest areas of demand, most notably in London, where we have, as with the rest of the country, but particularly an ongoing supply issue. How does increased lender caution around high flood risk properties balance with what we know is a really serious need to boost the UK's housing stock, particularly in these high demand areas? Jude, if I could come to you for this one.
All right, yeah. I've seen the eMove. articles I think that you're referring to. So eMove, the online estate agent, and yeah, their surveys have highlighted public concern in regard to climate change and showing which cities are at higher risk to flood, as you mentioned. So yeah, lenders need to understand the future risks, such as those identified in the cities and how they mitigate against it. And you talked about housing stock. I mean, ultimately, we should be constructing outside flood risk zones, but you know, this needs stakeholder alignment from government, developers, and investors. And I think it's probably fair to say that investors can play a major role. So investing in greener construction, they can do that by investing in firms with, for instance, leading environmental, social, governance or ESG practices. I'm sure you've seen that buzzword going around, ESG. So for climate change and future flood risks, they should form a key part of the E in ESG. But I think it's fair to say that, you know, some construction will still occur in flood risk zones, and Vanessa's highlighted things that can be done. Developers should design with climate change in mind. They can raise ground levels, build on stilts, and, you know, put higher steps to the entrance of buildings. So there are strategies there too.
There's some practical solutions, but yeah, we may need to rethink where we see as those important areas, might we? All right, so we are actually coming towards the end of our time. I know there's quite a few questions that we haven't been able to get through. But just to sum up finally, I want to ask, what comes next for JBA in relation to climate change? What can we watch out for in the future? Jude, can you answer this for us?
Sure. So I think we've clearly highlighted that climate change is a global risk, and that many regulatory bodies are looking at stress tests worldwide. But it goes beyond regulation, and firms need to understand their risks and the opportunities. So JBA already has global flood products for the current day, and we're in the process of creating global climate change flood solutions as well. So that's both for the data sets that Vanessa's talked you through today, as well as others that we haven't had the time to go into detail on. So there's plenty going on at JBA.
Fantastic. Well, I think we all look forward to seeing where the data takes you in the future. So yeah, as I mentioned, that does bring us to the end of our time today. It just remains for me to say thank you so much, Vanessa and Jude, for joining us. It's been a really fascinating insight into the realities of an area that, you know, I think we can all agree is only going to become more pressing and important as time goes on, both within this market and, you know, as a whole. Thank you to everybody in our audience for attending and to sending questions. I know there's quite a few that you guys have sent in whilst we've been talking that we've not had time to get around to. But I promise that there will be answers coming your way. Yes, thank you for attending. Hope you've enjoyed this Mortgage Introducer webinar in association with JBA. You'll be able to watch the broadcast again on mortgageintroducer.com or via our various social media channels in the upcoming couple of days. And yeah, all remains we say, we hope to see you all soon at future events, perhaps even in person as restrictions continue to lift. But for now, thanks everybody, stay safe, and it's goodbye from us.